Pour cela, je peux même en équiper 5 avant que tout commence, de la session 4.
Ouais. Attends.
Comme ça, ils gardent leur truc.
Salut.
Aucune idée.
Ouais, c'est le même gars.
Ah, c'est le même son. Je vois fait différemment.
Je sais pas.
On est plus. Pareil. Je cherche.
Oui, Caroline.
Pour ceux qui parlent, c'est oui, ils sont placés à l'avant.
Ouais. Oui, lui, c'est. Ah, c'est le
Je sais pas. Ah, les autres, ça va. Et l'intermédiaire, j'aurais pas de retour.
Quoi, t'en as combien?
J'en ai que 7. Il y en aura 2 qui seront pris sur le panel. Et j'en équipe 5 en attendant.
Il a Vernon, il fait c'est pas le moment. Predecessor, je connais pas. Il a rien, c'est bien. Je peux déjà aller demander à la NN.
Je veux bien. Ouais.
Maintenant ou.
Bah, dès que c'est possible.
Yes, I started that is not my new yes,
Les personnes bien connues.
Toujours pas, hein.
I don't recall any.
8, je vois ça peut-être. C'est avant.
Yes, yes, yes. Are you EFSF or?
That's right. Yeah. I'm just starting to actually switch. We can say at 6 a.m. So that's a different class.
I presume I have to hand over right after the meeting, so that give me a break.
There is a break actually. There is the keynote, and then the panel will be. And yes, after your panel, there is a
There
break.
is a break, so I can come here and get it.
Right, that's right.
Do I need to do anything to switch it on, or are you going to?
Yes, I thought it, I think there's a lot of parallels. Just after the the integration.
Good.
Technical part is by there.
But yeah, I don't. It's kind of like the US or something.
Je vais voir pour l'autre.
Yeah. I did work.
No, no, you absolutely no.
That is good. Thank you.
Billions. A lot of people like want to talk about like. Everybody's still kind of the same. They're putting a band-aid over it.
Monsieur, t'as un petit stylo, par exemple. Comme ça, je sais lire.
I think there are a lot of people that are skeptical. But I don't know how people like characterizing them. Because it feels like there's a behavior really there, right? Doing like, yeah, that's it's actually fun. Yeah, that's actually. If there's anything to go wrong, it feels like.
Bon, ça commence au 13 minutes, parce que ça va être rock'n'roll. Les switch, je le vois déjà venir, les switches de panel. Ça va être rock'n'roll. Elle, c'est cool, c'est
corporate perspective, right? That's there's risk in an investor perspective. And you know, the other thing is like, all it takes is the perception that investors have been, I don't know, somebody arrogant to invest in Italian firms and they're fraudulent as things go haywire. It's like, I don't know, it's like a lot there. But I think sure. Yeah. Maybe a bit. That Sure, sure. Yeah. Sure. Sure. Absolutely. It was. He's going to be.
Vous êtes connecté sur ESM Events, hein?
Yes.
Ah, guest.
Yes.
Il est sorti aussi.
Ouais.
Ah.
We're not using a fixed connection, not a fixed connection.
What for the?
So we can't
No.
You're using the guest.
Yeah, just the Teams. That's from that. That's the system. That's on the fixed connection.
Not that they're completely unrelated, just, you know. Like a lot of.
Il y en a deux qui sont des
Il y en a qu'un, Arnaud. Là, je vais équiper celui-là.
Oui, mais ah, ça va être hier. It's complicated.
To actually be as useful, but I don't see something that's okay, but this is just the US. It's not, but it just feels like there's not a.
Just that.
You're not involved.
Yeah, the machine is there. Like,
The score, they told me it was competitive.
I'm probably winning 18 decks. But just doesn't slam. Almost every fairness is used to get around. It's just like, I feel like it literally takes hundreds of years to actually go through that process. It sort of feels like we want to like, some progress we've already made. I think they just see. It's like dating somebody as a friend, right? It's like, it's either gonna work out. It's like, without a great experience, there's
Now it's honestly instead. That's what I feel. Maybe.
Yes.
Oh, it's between. Sure.
Yeah.
okay. Fine.
Okay.
At least.
Ok, donc la deuxième là, elle veut parler plus vite, donc je vais juste changer son nameplate. Après.
Parfait.
Et
Elle avait un micro.
là, elle veut un micro main. Ça, on est bon. Donc tu peux équiper déjà tout le monde de la session. Ok, j'en ai plus d'autres.
Je leur mets tous des micro-cravates, mais après, il reste le nous au rapide. D'ailleurs, c'était ça, hein.
Et ouais.
Bon, sur l'échelle, ça sert.
Après, les micro-cravates, c'est, je crois, plus simple que les DPA aussi.
À équiper, tu veux dire?
Ouais. Non.
Ouais.
Sinon,
les costumes, c'est bien.
Ouais.
S'il n'y a pas de costumes, donc je trouve ça un peu plus long.
Let's place the costume.
Après, le DPA, c'est mieux parce que là, hier, sur Instagram, normalement, les mecs, c'est comme ça.
Eh ben, c'est dur, mais.
On met de deux côtés. DPA, au moins, ça suit la tête.
Ouais.
C'est ça.
Ouais.
Normalement, sur 700 micros, tout le monde entend dans la pièce. Tu peux piquer ton stylo.
It was just for. And just what. We thought we would be like right in the city, and I would go my direction and she would go her direction. But it ended up being, so my parents were only like an hour away, so they came down to watch on the
Aujourd'hui, c'était encore plus un niveau de sécurité. Parce que t'en penses,
Ouais, c'est-
avait même plus de check.
Non.
I had like a 15-minute commute, like, and it was like, no, totally. That's. Absolutely.
So we had some Teams connection issues yesterday.
Yeah.
And I also received a message because there were a couple of times that I tried to connect and it didn't work. Well, I
Okay.
clicked like 3-4 times and it's connected.
Mhm.
And then I received a very nice message from Microsoft.
Okay.
Yeah. And actually, it wasn't just me. There were a couple of colleagues who had the same.
Because here it worked all day
Yeah.
yesterday.
Have any other comments? It was me
Yeah.
and two more colleagues, ESF people, not external.
Okay, sure. All the national parties and stuff, yeah. Sure. Yeah. Very different than the rest of those things. Yeah, I mean, apartments for it's all the time, like the next thing and all that, like, wait, that's like 12-hour drive. Yeah, actually, I mean, there's like, oh, but like, it's basically like Route 80 side, basically, you know? And then it's like 12 hours. And then these, like, you have DC and Baltimore, they go down and you go work.
Feeling like shark.
Yeah, thanks. I talked to you about It'll be good out of town. It's like, I don't want to have to like worry about how. No, but like, so Especially like student for not. But that's
All right.
I've got a bunch of.
Demain qui vient d'arriver, je lui ai dit d'aller directement à la régie.
Il en reste 3 avec.
C'est le, tu sais, celui avec les longs cheveux.
Aral.
Arad.
Et le Carrel, c'est celui qui avait posté le belge. Je
pense bien. Je vais essayer de voir son bateau.
T'as au plus vite bon, on allume. D'accord.
Kindly take a seat.
Oui, c'est lui.
Kindly take a seat. Aiutami a farli sedere, per favore.
Good morning, everyone. Welcome to day 2 of our conference, the EUI-ESM CPR conference on the Saving and Investment Union, bringing capital market to people and firms. I'm glad to see so many people in the room today, and we are honored to have our Managing Director, Pierre Gramegna, who will be opening this policy forum today. Pierre, the floor is yours.
So, Excellencies, ladies and gentlemen, it's a pleasure to see so many of you here today for this conference that our team prepared with a lot of care, a lot of enthusiasm and passion. They did it with so much that, in fact, I participated to the dinner yesterday, to the opening now, and then even to bilaterals, and after that, even with a lunch. So that tells you how committed they were, because they convinced me that I should be as committed as they are. Let me also thank all the partners that have played a key role here, in particular the European University Institute of Florence, especially with the high-profile academic workshop yesterday, and also thank the Center for Economic Policy Research, who were very valuable to help with the organization and outreach. I'd like to thank all the speakers, and what is key, and I think that epitomizes why we did this conference on Savings and Investment Union, because we have representatives from, I have to read it because there are so many types: banks, European institutions, national authorities, universities, and private sector. Well, as you might know from how attached I am, that we build bridges between institution, public sector, and private sector. It's probably one of the areas where we have a lot of progress to make in Europe. Now, I challenge you to make sure that I do not use the word capital markets union in my speech, because I have single-handedly decided, at least for myself, and encouraged my team, only to use the word savings and investment union, which encompasses the capital markets union and the banking union. And you know, we owe that to Enrico Letta and his report where he proposed that name. And why is that so important? This is illustrated by the seminar, because capital markets union or even banking union sounds to the public, this is not for me, this is for somebody else. No, this is for you, the people who save. This is for you investors in the financial field or investors in the private sector. So that's why it's important to use that name. So where does the ESM come into this? The ESM as lender of last resort, as the anchor of stability of the euro area. Well, some of you or many of you know us well, but still it is important to remember that the European Stability Mechanism is not only there to support and assist countries in times of financial crisis. That means when they are already in dire straits, as we did in the last decade. We are also there to prevent crisis, because preventing crisis is less expensive and more efficient. And preventing a crisis is key. In that sense, we have a similar task as the IMF, and that's why we study the economy, we look where all the risks are, and try to be alarmist when necessary and pinpoint to the difficulties that are out there. We sit in the Eurogroup every month and contribute to the discussion there. And one of the main additions that the ESM can bring is the knowledge of what happens on financial markets, because we are active on financial markets, as we have close to 300 billion euro out there that we finance and refinance. And that knowledge is precious for ministers. Now, I would say the opposite. What are the key advantages of having a savings and investment union and a more integrated financial markets? I see four. They will not surprise you, but as an introduction, it's important to repeat this. It would first of all improve the resilience of our economies to external or internal shocks. And if we have a better resilience and resistance to external shocks, obviously that strengthens financial stability. The second one is that a more integrated financial environment in Europe is important and good for risk sharing across the whole European Union. And that is good for both national economies and also good for enterprises. And if we cushion the risk for national economies or for enterprises, then that again reduces the risks of financial instability. There's two other elements which are also quite obvious, but I would like to highlight them, is that if we have more integrated rules, similar rules, I would dare say the same rules, well, we have a better and more efficient allocation of resources and capital. Then this is very important, and that's the fourth advantage, to attract foreign investment. So it's good for national, internally investment to be done in the best place, but attracting foreign investment, and even more so because we are integrated, is key and would boost growth. Now, you are all aware that since 2022, Europe is growing at a rate of less than 1% every year. In fact, Harald, who sits in the Eurogroup with me, and he's the longest standing sitting there. I'm one of the longest standing also with different hats. In the last 4 years, you could write a story saying the forecast is that this year we will have less than 1%, but next year we're going to have 1.5 or 1.8. During the year, the 1% becomes 0.7, 0.6, and the one of the next year becomes close to 1. Scenario has happened 4 years in a row, is again happening. And then the year after, we say, then we will be above 1. So what is going wrong is not that the forecasters are not good, is that our productivity, our competitiveness is not good enough. And second, there are so many shocks, external shocks and economic ones, but also a geopolitical landscape that makes predictions very difficult. When the American administration announces another reversal in tariffs policy, markets go up and down. And if the tariffs are extremely high, you can forget selling any of your product to the United States from one day to another. So if you ask a company, how is your year going to be? If you ask the day before that announcement or the day after that announcement, the perspective is completely different. So it's not that I'm saying that people are doing things wrong, but it's exactly this atmosphere of geopolitical turmoil, of trade tensions, and that's a great understatement, that justifies even more that we integrate our financial markets. Now, the goal of this conference is not to do magics, but to be down to earth. So the team prepared a very good paper that you had discussed yesterday with concrete proposals. I'm just going to say a few words on that. Concrete proposals, because let's face it, in Europe, we cannot act in a minute. We have to do it step by step. And the Savings and Investment Union is an endeavor of many facets. So let's focus on what can be achieved in the short term, because there's less resistance and because they deliver concrete results. So a few things that were mentioned is retail savings, so Pillar 2 and Pillar 3 pensions, and the goal being to unlock long-term capital. We have the highest amount of savings in the world. It's over 30 trillion. And a lot of that is not smartly allocated. There's also a big challenge to see how our banks can have a bigger role in our economy. And I find that very interesting that the team highlighted that, because what we keep on hearing in Brussels and everywhere else is that in Europe, enterprises are financed to 2/3 by banks and 1/3 by equity markets. And in the US, it's reverse. Equity markets are 2/3. So the conclusion you might draw from that is we should be more like the United States. I'm not sure this is the right conclusion. I think we should do it our way, and it should not be our goal to necessarily imitate the success story of capital organization in the United States. But our banks, and it's also their own role, it's not governments who can decide for themselves, they need to reinvent themselves to continue to play an important role, if not a bigger role. Let me conclude by saying that this project, which is now called Savings and Investment Union, was first announced by Jean-Claude Juncker in 2014 in front of the European Parliament. So it's more than 10 years ago. A few things have happened, but not enough. The Draghi report and the Letta report, they tell us what all this entails. It goes even farther than what was initially thought. I find that deepening and modernizing the single market is also as important as the savings and investment union. It's the combination of all of this that will boost growth inside the European Union, and which will make us stronger and attract more foreign investment. Now let's, and I will conclude on this. I haven't talked a lot about geopolitics. I did that a little bit yesterday over dinner. Let's not count on others changing their policies to please us. Let's not gamble on the fact that the policies that are now existing and developing in the United States will all be reversed with another administration. That's not true. I take only one example, but there are many others. Do you really think that the next American administration will have a smoother foreign policy with China with another president? I don't think so. Those who get upset because Trump is insisting that European countries should deliver on their promise and commitment to spend 2% on defense. Do you think that it was a good idea that we did not deliver it? But the first president who asked us to do that was Obama. So if I take only these 2 points, you see, this is a long-term trend. And so let's not have the nostalgia, it was better before. It was better before 20 years ago, 25 years. That's what we want us to come back. It will not come back. We can hope, knock on wood, that on trade policies, one day the United States will realize, whoever is the president, that fostering fragmentation, having high tariffs, is disrupting world trade, is reducing world trade, is reducing world growth. And the tariffs, the one who imposes tariffs is hit twice as hard than the countries that are victims of it. So markets have understood that. And it is also the markets, the financial markets in particular, that are going to also bend a little bit some of the policies because they are not sustainable and they are not in the interest of the United States. But in a nutshell, let's not hope for a better world to come out of the blue out there. We need to do our homework, because what I mentioned, savings and investment union and modernizing the single market, is in our own hands. So my conclusion is very simple. In these times, we need more Europe, not less. Thank you very much.
Good morning. Hello, ladies and gentlemen. It's a great pleasure for me to be here with you today, and I want to thank the European Stability Mechanism, thanks Pierre, and the Florence School of Banking and Finance, thank you very much, Thorsten, for organizing this conference and for inviting me to speak here. Forums like this, as you already said, Pierre, bringing together this varied perspective of policymakers, academics, regulators, and private sector industry representatives are essential for the collective critical reflection on important initiatives such as the Savings and Investment Union. And I very much appreciate the opportunity to be able to lend my voice today to that debate. As ESMA, we welcome the renewed attention to the Capital Markets Union, or as you rightly say, now the successor, the Savings and Investment Union, or SIU. The strategic importance of well-functioning, integrated EU capital markets has become increasingly clear, economically, socially, and geopolitically. We recognized this also in last year when ESMA published its position paper, which outlined a number of recommendations that could build more attractive and effective capital markets in the EU. 1 year on, we now have the strategy from the Commission, and it builds very much on the reports of Mario Draghi, of Enrico Letta. It's very much aligned with what we put forward last year, but also what many of you have put forward, including obviously also the ESM paper and other academic studies. The Savings and Investment Union is an important lens through which to view the EU capital markets. It highlights the fact that financial integration is not just about reinforcing the status quo. It is about enabling citizens to participate in Europe's economic future in a more meaningful way. It is about widening the reach of European capital so it can get to innovative and strategic projects that need it most. It is about strengthening the resilience and efficiency of our financial system so that it can better serve our needs in Europe. The necessary steps to achieve this, as they are set out in the SIU strategy, are wide-ranging and certainly challenging. But to my mind, ambition and vision are a prerequisite for us moving forward, and I very much welcome the European Commission's strategy in this regard. Through the recent consultation on market integration and supervision, the Commission has wasted no time in putting on the table some crucial topics for further consideration and comment. And thank you, Andrea, and all your team for doing that so quickly. I want to focus today on one particular topic, which is obviously close to my heart, and that is supervision. You won't be surprised to hear. I'm the first to emphasize that supervisory reform will not transform European capital markets alone. But I do believe it can be a crucial enabler. Yet this debate is often framed in contentious and political terms. While that may be true, I think it is time to really look at this question in as objective a way as possible. We must look at the ways and means of bringing more coherent and effective supervision to the financial markets across the EU, so that the framework delivers for markets, for investors, and ultimately for our economy. To support SIU, supervision must be effective and efficient. It must enable firms to operate and grow across borders within the single market with clear and consistent expectations. It must provide equivalent outcomes for investors and users wherever they are in the European Union. And it must support financial stability without creating duplicative or uncoordinated approaches. Today, we have a two-pillar approach to the supervision of our capital markets. The first and most important pillar is national supervision, where the primary responsibility lies with national competent authorities, like the CSSF here in Luxembourg. They are on the ground, close to the firms that they supervise, and carry out most of the day-to-day supervisory work across all of the European capital markets. National supervision is the backbone of our financial system and certainly will remain so, particularly where the business of those supervised firms is domestically oriented and engaged with local investors. Through a process called supervisory convergence, then, ESMA works with the NCAs to ensure that EU rules are applied consistently and effectively across the whole of the EU. The second pillar, much smaller, is EU-level supervision, which is where ESMA plays a more central role. Here, ESMA serves as a direct supervisor of specific types of entities that serve as infrastructure to some highly integrated or cross-border market segments. This two-pillar structure recognizes the diversity and the complexity of our markets. It promotes convergence of national supervision while supporting a gradual, proportionate evolution of EU-level supervision, thereby maintaining overall coherence and finding the most efficient and effective supervisory approach for the wide range of different market players in our EU capital markets. ESMA first became a direct supervisor in 2011, soon after becoming a fully fledged European supervisory authority under some of the first post-crisis reforms. Interestingly, ESMA was the first EU-wide supervisor of financial entities, assuming oversight of credit rating agencies 3 years before the single supervisory mechanism was created. Over almost 15 years, ESMA's experience and authority as a day-to-day supervisor has grown steadily. Today, ESMA directly supervises credit rating agencies, trade and securitization repositories, along with some benchmark administrators, data reporting service providers, and non-EU central counterparties. This range of entities also continues to expand with more types of market players due to come under ESMA's supervision soon. Amongst others, the verifiers for EU green bonds, the ESG rating providers, and also consolidated tape providers. Each of these mandates was given to ESMA because it was evident that our pan-European perspective could support sound and consistent supervision and safeguard the integrity of the markets. These entities are all actors that operate cross borders, serving the whole of the EU market. In some cases, these were also emerging areas, to be fair, where supervisory activity and experience had not yet grown at national level. In this respect, EU co-legislators considered that ESMA was best placed to provide EU-wide and comprehensive supervisory oversight, rather than allocating responsibility across 27 different national supervisors. Importantly, ESMA's performance in these roles has demonstrated, to my mind, that we are an EU-level supervisor that is credible and effective. We are informed by a clear risk-based approach, grounded in strong technical expertise, and accountable under a clear governance framework. And it is through our ESMA governance that national authorities continue to play an important role collectively as key decision makers in some of the important supervisory decisions in the ESMA board. It is on this basis, and because of this growing supervisory experience, that we believe it is now time to ask the question whether the current balance between national and EU supervision remains appropriate for all parts of our capital markets. The question is all the more pressing in light of the ambitions that are underpinning the Savings and Investment Union. We think the answer is, while for the vast majority of the market it is right that national authorities are and continue to remain in charge, for some key segments it is probably time to reconsider and shift the dial. This is particularly the case for large cross-border market infrastructures such as CCPs, CSDs, and potentially other systemically relevant actors like trading venues or critical crypto asset service providers, as another example, a new kid on the block. These are firms whose activities are fundamentally cross-border in nature. They enable core market functions such as trading, clearing, and settlement, often in multiple jurisdictions simultaneously, operating integrated platforms across member states. The risks they assume are not just domestic in nature, but shared across the whole of Europe. Fragmented supervision in such cases can be inefficient for firms themselves and for the market overall. It can also introduce unnecessary risks. These are not just theoretical concerns. Market infrastructure is the backbone of our capital markets, and ensuring its oversight is joined up and focused on cross-EU risks and objectives is not just a question of efficiency, but it's also one of resilience and competitiveness. To my mind, the benefits of EU-level supervision here in these specific areas is really tangible. For firms, it means fewer supervisory interfaces, clearer expectations, and less duplication and contradiction. For our capital markets, it supports consistency, simplifies cross-border operations, and improves the functioning of the internal market. It allows us to have a more singular perspective on the systemic interlinkages in our European financial markets. For the Savings and Investment Union, moving forward with some targeted EU supervision can reinforce, to my mind, the cohesion and show our determination. It reduces the scope for diverging practices and helps build trust that the rules and their application, supervision, and enforcement are the same for everyone. This trust, in turn, can help build confidence among investors and companies in our EU capital markets, whether that's domestic investors or foreign investors. And lastly, for the EU as a whole, I believe it strengthens our global competitiveness. As you already mentioned, other jurisdictions such as the US already offer large and unified supervisory environments. If we want to match their scale and efficiency, we need to reduce friction and complexity in our own system. Let me be clear, this is not a call for sweeping change across the whole of the capital market segment. This is about specific, targeted enhancements to the EU supervisory architecture, where the cross-border nature of activity and the importance of the function of the EU markets clearly justifies a more centralized approach. This is not about taking away from national supervisors. On the contrary, NCAs remain critical partners in making sure that our supervision works. ESMA represents the coming together of collective thinking, of collective analysis, and collective decision-making of all European supervisors. And this will remain a core characteristic of how we work. We all recognize the need to make sure the right level of supervision is applied to the right market entities. As such, the ideas on supervisory reform in our position paper last year represented the shared views of the members of the ESMA board. To conclude, the supervision of EU capital markets is certainly complex, it's sensitive, but ultimately it's a crucial part of our integration story. If we want capital to flow more freely, and if we want the EU to finance its future, then our supervisory setup must match our strategic aims. Thank you very much.
Excellent. Let's take a couple of chairs.
I would like to invite you to the stage for a brief discussion. And thanks a lot, Verena, for reminding us of the critical importance of the SIU strategy and critical role of supervision.
Thank you for coming. Thank you for your wonderful remarks. You just said you're not calling for sweeping change to the system, but many in this audience are or have been calling for sweeping change. So what do you think about becoming a broader single capital market supervisor if the political will is found? Do you think that would be a good end state to dream of?
Thank you, Rebecca. No, first of all, I think everyone is calling for sweeping changes when it comes to the whole reform of our capital market. So I'm certainly calling for sweeping changes when it comes to the whole of the SIU agenda. I focused here on one particular narrow but important point to my mind. And there I believe, as I said, that we need to look at where can we find an approach that combines the respective strengths and the effectiveness of everyone to the best effect. And so that's why I was saying I'm not calling for bringing all supervision to the EU level.
But some of them are. And what do you think about it?
I think it's certainly something that obviously sounds fantastic. If you're ESMA, it sounds great if you talk about the European SEC. But I'm also someone who is pragmatic and realistic. And I think to me, it is about making sure that we actually focus on the area where it makes most sense to do that. And on top of that, I think we also need to be realistic about what can be done and where we want to put our emphasis and our resources. If we want to really be making sweeping changes in the SIU as a whole, we need to make sure we change something on supervision. But I'm not sure building a complete US SEC now, rather than doing it step by step and focusing on the area where it makes most sense, is necessarily the best use of our resources and time.
Thanks for that. I was in an event a couple of days ago where we were talking about the possibility of putting ESMA offices more out in the member states and dispersing among some of the major financial centers. And one of the panel participants said, you know, the SEC office in New York is very powerful, even if they're still tied to headquarters and still a federal agency. Is that a model that you think could work in Europe, particularly if some of the duplication could be addressed, for example, transferring some powers to, you know, the distributed office of central ESMA?
So I think you're getting into a topic which is clearly a difficult one, and in particular, it's around how you organize and what governance arrangements you make around this. I very much believe that our current governance and arrangements actually work effectively, also for our direct supervision mandates. And so I think you need to think about how far-reaching, again, do you want to be in the changes? As I said in my speech, I think we need to make sure that we get the best out of our collective expertise at national level and at EU level, and we combine that to the best of our effects. But it also needs to be clear who is in charge and who has responsibility. And so I think we need to, we can use and we should use the resources and expertise that exist at national level. We should not just duplicate and create two layers which are both doing the same thing. We need to make sure that we have a system that's efficient. I think that is one of the calls that I would very much support.
Super. I have one more question for you, and then we'll throw it. I have many questions, but I have one that I'm going to ask, and then I'm going to open it up to the floor. And the question is, what do you think should be the balance between coming up with standards and really focusing on implementation of rules, you know, peer reviews, the direct supervision that ESMA has? Do you see that maybe there should be more attention paid to setting up systems as we get into these new market structures, or really on implementation and enforcement?
As a supervisor, I would say, you know, it's not just having the rules, it's actually making them work in practice, and that's implementation, supervision, and enforcement. And I think that is where we need to focus collectively as the European system of supervisors, and maybe more than we've done in the past. And I think it also combines a bit with the general agenda on simplification and burden reduction. Do we really, in all cases, need to put everything into detailed rules, or can we actually do collective key supervision and implementation collectively that actually can also deal with some less detailed rules and still make them work effectively in the European Union in a consistent way?
Thank you. Let's open it to the floor. Does anyone have questions? Rolf, yes. And do we have a roving mic? Or yes, looks like we do.
Thank you very much, Verena, for your remarks. I would like to broaden a bit the topic in a sense that many people say maybe centralization of supervision is not the step to take, but we are fine with harmonization. So my question to you is basically, how do you look from your perspective at this issue of harmonization? Where do you see the potential for a 28th regime? And how do you, in that context, then also see the linkages to more centralized supervision? What would be the impact from your perspective?
So I think if I look back at, and I'll use the word capital markets union, we have done a lot of work on trying to harmonize, to create the single rule book. I mean, ESMA has been very active in trying to pursue that. But in the end, and it comes back to the implementation and supervision, there are limits if you don't then have a common approach to the supervision and implementation behind that. And so I think it is important that, for me, harmonization can't just be purely on the rules. I think it also has to be on how we actually, what's our supervisory approach? What are the common risks that we see as most important? How do we actually then address those risks? And how do we make sure that all firms are living up to the same level of expectations, and we create the trust and the ability to really work in the single market? So for me, that is core. I think the 28th regime is being talked about a lot. I think people have very different views on what that actually means, and also what areas you would want to cover under a 28th regime. There are clearly some basic legislative areas which are still very diverse nationally, which are hard to harmonize, and where maybe a 28th regime might provide a solution to overcome some of the fragmentation and barriers that are still there. But I don't see it as necessarily the solution for everything that we are facing.
Yes, behind right there.
Hi, Verena. I wanted to ask you about where do you see the limits for supervisory convergence, in the sense that the world is now advancing in terms of this AI revolution, and ESMA started a path a few years towards data-driven supervision. And how can that help the shift towards a more centralized supervision by ESMA?
You touch on a couple of important points, Joe. I think one, I would say, is that we live in a world which is increasingly digital, increasingly borderless, and where, people who are not necessarily the most benevolent factors will try to use that ability to set up anywhere and then serve the whole of the European Union. And if we are not fully aligned and working together in a consistent way, then that will create real risks, I think, to our financial markets and to our investors and consumers, most importantly. So I think from that perspective, the convergence activity and making sure we strengthen and continue to work on that remains absolutely key, particularly as long as supervision remains at national level. I think, however, you're right to say there are certain limits to that at some point where, and that's why I raised the areas where I believe we might want to take an extra step to actually go from just more convergence and more convergence activity to saying, actually, it's more efficient, it's more effective to actually go for a central supervision. And I think data plays a key role in that, and that's something we've argued for a long time as well. Let's try to work on using data more effectively. It's the most important supervisory tool that we have. And we need to make sure that we, however, also think about how can we reduce the reporting burden that puts on the industry and on supervisors as well. And how can we make sure that we actually see whether we can find data flows that are genuinely standardized, that we can collect once in the European Union and not build 27 different IT systems not properly share the data between the different authorities, and with that make our whole system so complex and so burdensome. So there are also opportunities there on the data field, I very much believe, where you can centralize, where you can create a single hub and then share that data back to everyone who needs it for their supervisory purposes.
Thanks for that. Veronique? There is obviously a lot of talk about I would say, the vertical aspect of supervisory organization or framework between the European and national level. My question would be on the horizontal axis, i.e., how can we better improve the collaboration across the ESAs and possibly also including the SSM, make it more efficient? You mentioned data sharing vertically. I think data sharing horizontally is also very important. ESRB is part of the picture, of course. We have a very fragmented architecture coming from the Larosière report, whom I will not criticize. But there has been some initiatives like the joint committees. Is there progress on the table on that side? Because my sense is that especially capital markets projects or ESG subject, because I think we still need to talk a little bit about ESG, and IA and crypto and so on and so forth are actually transverse issues. And in the same way as it may not be meaningful to create skills in every member state, maybe it doesn't make sense to create skills in all the across all the horizontal aspects. Is this something which is being discussed?
Thanks, Veronique. So I would, from my perspective, very much support your point that, our markets and our financial sector is interlinked between the different sectors. So cooperation across banking, insurance, capital markets, pensions, whatever it is extremely important. And I have to say our coordination and cooperation with the other two ESAs from that perspective works, I think, pretty well already. We can always improve, and I'm certainly one who would always argue we should do even more together. We should make sure that we actually also are willing to look at where are, specializations where it might make sense to just bundle the expertise rather than trying to replicate and things like that. Similarly, all the work that we are doing collectively across the three ESAs on financial stability is very much brought together by the ESRB. We have a lot of contact with the SSM. Also, some of the biggest banks are also the biggest capital market players. It's extremely important that we interact, that we talk to each other, that we understand how we each are looking at some of those risks and issues. So there's a lot of maybe not that visible cooperation already going on. And I would certainly argue it should only increase given the increasing interlinkages between the different sectors.
Verena, sorry, I would like just to ask you to share with the audience your ESMA experience in direct supervision, which is an area of ESMA work which is not much visible to the large public, and this probably is very important to mention. ESMA did some enforcement on the entity directly supervised, and some of them were directly supervised from day one, as soon as ESMA has been created. So if you can share your experience in those, let's say, more than 10 years. Thank you.
No, sure. I think, yes, the fact that ESMA is actually day-to-day a direct supervisor of some quite significant and important entities in Europe, and where there's no national supervision and everything is done at the European level, is maybe not that well known broadly. I would hope that many here in the audience are aware of it, but maybe not that many outside of it. And I think it's something that I think is important to talk about. We are actually experienced as a day-to-day supervisor. We have, the experience of authorizing entities, of conducting day-to-day supervisory work, whether that is risk identification, whether that is on-site visits, whether that is looking at making sure that there are remediation plans for issues that are not working well, or whether that is ultimately going to enforcement. And so if you look at our track record, we have taken enforcement actions against particularly our first main supervisory mandate on CRAs over the years where credit rating agencies have not properly followed the rules, where they have not, for example, given the transparency to the wider market on particular rating actions and so on. And that is important. I think you really need, as a supervisor, those different aspects of first setting the bar high when people come in, then making sure you hold them to the standards, and ultimately also having the power to enforce when you need to. And all of that is a process which we are very well used to. We have been doing for a long period of time, long in our history, a long period of time, 14 years. And I believe we have shown that we can be a credible, risk-based, outcome-focused, and data-driven supervisor. So I would hope that also gives some credibility to saying, let's give us a chance to also show that in some other areas.
Do you think that these examples of direct supervision offer examples of how types of 28th regime, if we go with a 28th regime here and there versus the, is this a model, or would you see that being a fundamentally different structure than what you have now for the areas where you do have this direct supervision?
I have to admit, I am not a legal expert as such, and I think for me, the 28th regime has always been more of a legal concept, particularly when it comes to areas such as insolvency law and things like that. I think it's a difference of that, to my mind, to doing day-to-day supervision, which is what I was talking about. So I'm not quite sure I immediately see the link, but I'm happy to be educated on that.
Well, I think we're all exploring it as we go along. We heard Tobias's thoughts, and we're thinking about it. I think we have time for maybe one or two more questions if people have them. Yes, Roger.
Hi, Verena. I'm Roger Silvers from the University of Utah. I have a question for you. It seems like a lot of the discussions that we've had seem to frame the risk of the SIU or Capital Markets Union as we don't achieve the benefits. But do you see additional risks in terms of more catastrophic types of outcomes if you try to be? It seems like your talk referenced, a little bit more selective efforts at specific types of integration rather than a more comprehensive one. So what do you see as like the worst possible outcome and the biggest risk?
I think, if I look at our European capital markets, first of all, we live in pretty uncertain times. So I think, when it comes to market volatility and geopolitical risks and all of that, Pierre mentioned some of them, I think I see significant risks, and I think a strong supervision, a stable and credible regulatory framework has something to call for, to also make sure we have a resilient market that can face those type of risks. I think for me, the market is already moving to that more united single market, because the reality is with digitalization and everything else we are creating, that market is there. Many of the players, most of the players, at least the big players in Europe, are serving not just one or two markets, they're serving a variety of different markets, and therefore all the risks that we have in the system automatically become cross-European risks, particularly when we talk about the more systemic financial stability risks. But I would say even in the investor protection phase area, if you look at some of the digital developments and, when you look at crypto asset service providers, for example, we are getting to the point where, it's very hard for a single national supervisor to actually keep that bigger objective of protection of investors across the European Union in mind.
Thanks. Yes.
So if I may pick your brains on one aspect, I mean, I fully understand why top-level European bureaucrats dreaming of a European SEC, but given your very impressive career, during which you have actually worked for a pan-European, de facto pan-European supervisor, simply because the City of London essentially has been to go to a trading venue in many markets, does centralized supervision necessarily mean supranational supervision, or could we not imagine a system where we rely on national supervision, but concentrate on certain markets that are simply just like the city pre-Brexit, are the trading venues in Europe. Is that a vision that's also appealing to you or not?
So first of all, I think you need to distinguish, to my mind, two different things. One is, even if you work for a supervisor that actually has responsibility for entities that have a genuine cross-European reach, ultimately, your objectives, your responsibilities are determined at a national level. That's how you're going to be judged. That's the public, the parliament, the accountability that you have. So I think there is a difference there that is purely about, your spirit. Even if you are very European-minded, ultimately, you are driven by the responsibilities and the objectives and the parliamentary and legal framing that you are. Secondly, I believe we have a real strength in Europe, and that is indeed the specialization and the real expertise that we have in different parts of our market, in the market and the ecosystem that is there, and also in the supervisor that exists. And therefore, I believe we need to build on that. It is something that is a strength of Europe, and I would not want to, destroy that in the way that we are handling the next step. We need to build on the expertise that is there. I think we have created very effective regional expertise centers, and I think they have a role to play in whatever the future of the SRU is. I think it's just making sure that that specialization generally serves the whole of the European Union.
Thank you so much. This has been really interesting. We could ask you questions all day. As a last one, you mentioned the ESRB, and I was wondering if you had any thoughts on how that might change as the balance of power among supervisors went. I mean, just what would it, long term, what should we be thinking it's for?
The ESRB itself has conducted a bit of a review of that and has put out, some ideas about the longer term vision, which obviously ESMA, as a member of the ESRB, has also been involved in. But I think if I look at what it does now, what it does very well is actually bring that unique perspective of a European financial stability risk board together and bringing the people who are around the table to focus on that perspective collectively. So I think that is something which clearly it has done and it will continue to do, and I think it plays a very important role in that.
Super. Verena Ross, European Securities and Markets Authority. Thank you.
Thank you very much, Verena, for sharing your vision and your insight with us. I would like to invite Elena Carletti for session 4, Acting Now, Preparing for the Future. Elena is Professor of Finance and Dean for Research at Bocconi University. She is the Deputy Vice Chair of the Board of Directors of UniCredit Group, where she also chairs the Risk Committee. Elena, I will leave it to you to introduce your speakers.
Shall we, even though we don't have much time, why don't we?
Speaker.
Good morning. Good morning to everyone and welcome to the first panel session of the conference entitled Acting Now, Preparing for the Future, a high-level debate on deepening capital markets in the European Union. We have an excellent and also large set of speakers. Let me introduce them in alphabetical order. We have Johan Almenberg, who is the State Secretary to Swedish Deputy Finance Minister. And in his responsibility, of course, include financial market regulation, policy, public property, and the Swedish pension system, which is a core part of what we are discussing. Then we have Arnaud Delestien. He is the Director of International Capital Markets and a member of the Executive Committee of the Luxembourg Stock Exchange. Then we have Karel Lanoux, who is a chief executive at EFSF, and he has been in this position actually since 2000, so for a very long time. Then we have Veronique Ormezzano, who is an independent expert in financial regulation, financial policy, sustainable finance and governance. And before, she has been very well known as the head of regulatory affairs of BNP Paribas until very recently. And then last but not least, we have Harald Weiglein, I hope I pronounced it correctly, who is the Director General for Economic Policy, Financial Markets and Customer Duties at the Austrian Ministry of Finance. And he has been there since 2012. He has a number of positions in many policy institutions, but for what concerns today, his position included that of the chair of the EU Financial Service Committee. So he's very much in the discussion as to what we are discussing on this EU and so on. So the discussion, we have 3 panel sessions today. This one wants to focus on key priorities and key objectives of this EU, where we need to invest more now to prepare for the future. We have only 1 hour, so I would kindly ask you to really watch your time when you respond to questions, and we try to have 2 rounds of questions and then open for the floor. So let me start with leading question for sort of introductory remark. Veronique, let's start with you. So taking a step back and starting with a broader reflection on how the European financial sector should look like, what is your big picture vision for the EU?
Thank you, Elena, and thank you to the ESM for the kind invitation. I'm really pleased to be here today. Thank you for entrusting me as a private sector representative with this very delicate role of speaking first in such a distinguished panel after the words of Pierre Vermeer and Bernard Ross. Indeed, I'd like to step back and reflect on the underlying goal of the SIU. As much as I really thought that the SIU roadmap that was published by the Commission was great in the sense that it is very concrete, pragmatic, and ambitious, it's still a shopping list of subjects. I think there are 22 initiatives, each of them, timed, and this is a great roadmap, as it should be. But I think it is very important that if we want to achieve the outcome, if we want those 22 initiatives to align and deliver their role, as we discussed before, I think everything is very transverse. I think we really need to have an overall vision and a purpose. So let me focus very shortly in vision and purpose. The vision, to me, is what is the EU and the EU policymakers' view as to what is the kind of financial system that fits Europe. I was interested by your words, Pierre, that we may not need to mimic the United States. Certainly, in the current situation, the appetite to mimic them is probably less than ever. I do welcome also this new SIU narrative because indeed the segmentation between capital market union and banking union, I think, was leading to maybe a misconception that one should develop at the expense of the other, which is probably not the case. I would suggest maybe we need to do one further semantic step, which is, as opposed to say the SIU is the sum of CMU plus BU, maybe we should say the SIU is the capital markets and banking union, because today the SIU is a little bit too much the whole series of subjects that were already on the table under the CMU, the old CMU. And then, oh, by the way, there's also the banking union. And on the banking union side, it's the inheritance of the old, quote-unquote, banking union, which we know is also 10 years old and if not more, and actually has a number of difficulties and continues to be very focused on crisis management as opposed to competitiveness and growth. So I think this is very important to recognize that maybe we do not want to reduce the dependency of the EU economy to bank finance. Banks continue and will continue to play an important role. And given the massive investment needs, there is no doubt that we need to grow both the banks and the capital markets. and not one at the expense of the other. I think it's also important for all member states to realize that capital markets is not against their system, if you like. It's really inclusive. That, I believe, is a very important point that could be emphasized by policymakers. Why do we need to grow both banks and capital markets? The amounts you all have in mind, the 800 billion euro of annual additional investments from the Draghi report, at the time not including any defense spending. But what we have not in mind maybe is how this is such a big figure, how does it compare to the current capacity of the EU financial system? Over the last 10 years and removing the years of COVID where the amounts were totally distorted by state-granted loans and these kind of things, the overall amount of financing which is put on the table, public and private, equity and debt, bonds and loans, in Europe, in the EU, is 400 to 450 billion. So if we say we need 800 additional, this means we need to triple the capacity every year. It is huge. Of course, some people say, oh, banks have capacity, they have skyrocketing capital markets, capital ratios, and so on and so forth. But the reality is that it is far from easy. If the 800 billion do not materialize, and this is not so much on the financial side, it is more on the competitiveness side, then of course we may not need this capacity. But if we have to assume that we do have the plan to implement these competitiveness compact in all the sectors, we will need this. So I'd like to say also two quick things. Banks are best placed to originate and monitor loans. Why? Because they are close to the clients, and from a financial stability standpoint, they are very tightly regulatory and supervisory framework. So it is actually quite a safe origination process to rely on banks. And this is why securitization is so important, so that then we can get the best of both worlds with capital markets entering into the risk-sharing transactions and benefiting from this highly regulated bank origination. One word to conclude on the purpose. Financial sector in itself is only an enabler. What is important is what it means for and how it can serve the economy. So what really matters to me is to guarantee to EU citizens and businesses equal access to financial services, whether it is about borrowing, investing, or paying. Payments is a different topic. We are not going to address that today. What I think that the SIU project should aim at, even more than maybe allowing savers to make a little bit more money by investing better, is also to create a single market for finance where at the same level of, for example, credit risk and financial needs, the people across Europe should get the same conditions to buy financial services. How this is not the case today, and that creates a huge social gap between countries for citizens and a huge competitiveness gap for corporates. On the citizen side, look at what has happened in the monetary policy tightening of 2022, where households in Spain or Portugal had to pay their mortgage installment much higher, which did not happen in other countries. How can we talk about a union if we have such differences in behaviors? How can we talk about a union if an Italian company competes with a German company, but its cost of funding of its Italian bank is much higher than the cost of funding of its German competitor with the German bank? So these are the kind of gaps that are essential and that should be at the core of the SIU project. I will stop there. Thank you.
So vision and purpose, and we will keep it very clear in our discussion. Harald, let's go to you. How do you see the balance or trade-off, if any, between all components of the current CIU roadmap, and in particular between markets and the regulation?
Well, if I look at the SIU roadmap, I think it's a bit too early to be able to analyze trade-offs, because it's basically a roadmap that sets dates for important pieces of legislation. I think the topics are well chosen. All these areas need to be reviewed. But we can only say whether they're effective and whether there are trade-offs when we see the actual pieces of legislation. And securitization will be the first that we may be able to judge on the 19th of June. And I'd probably answer your question in a different way. Sometimes it's useful to have these little thought experiments. So if we imagine we had a European Union, but we had no bodies of national law, how would we go about to organize a capital market? I mean, we would still have the language barrier. That would be the main big difference that we can never get rid of, and that's always, that will always be different to the US. But we would probably have, one set of rules for financial reporting, because, I mean, financial markets work on information, reliable information that should be comparable, transparent, and the same for every company trying to get the listing. Then, of course, shareholders and bondholders would have the same rights in exercising their rights as shareholders, shareholders' directive, voting in general assemblies, but also in insolvency, obviously. So that would be the second thing. Taxation would be the third thing. So why would the same investments be taxed differently in a single market? And if we look at what we actually have now, I mean, we're very far away from that. We talk about tiny bits and pieces there, tiny bits and pieces there, incremental changes, which are fine. I think these things take time, and don't underestimate the size of the project that we undertake. We have already 2 action plans with very, very big pieces of legislation. And to begin with, we had success stories before we were talking about capital markets union that nobody mentions. I mean, the UCITS is a success story that it was unlucky that it happened before we started discussing capital markets union. Would we invent it now? It would be a big success story. So the big things are the things that take time, that we maybe don't address in the proper way because we don't think there's political support for any of these. And even if we got all the things right that I mentioned, we still would not have solved the issue of demand. And here we come to an area where the European Union has no responsibilities and competences, social affairs, because the big difference in demand in the US market are the 401k plans. And we are very fond of a strong first pension pillar in Europe. It's very dominant. And if you're a risk-averse investor and you are fine with what the first pillar provides for you, why would you invest in a capital markets union? Even if my insolvency rights in, say, Portugal and Spain are assured, there's no need for me to do that because my retirement is provided for. And that is probably the most difficult thing because we will probably not be able to agree on a pan-European pension reform. We looked into second pillars in the FSC, and you can find that in our FSC report on capital markets union. We found that only 17 member states actually have second pillars. So for me, that would be an obvious area to start. I mean, strengthen the second pillar, look at countries that don't have them, look at the countries that have them, and where they're not particularly strong, what can you improve there? And that'll be part of the monitoring exercise of the Eurogroup. But it's all up to member states. Since it touches on social affairs, it's up to the member states to do something there. And also just to explain to you how difficult some of these things are. The second pillar, meaning occupational pensions, are in some countries part of the collective bargaining arrangements. For instance, in Germany. No. So if you want to change anything there, good luck engaging with the unions with the capital markets objective. Maybe one last word on the things that I haven't mentioned. When I'm a big fan of learning from things that work. And we have a couple of very successful countries when it comes to aspects of capital markets, Luxembourg being one of them. And I'm always puzzled when we talk about things like, I mean, we had the debate about joint supervision before, where, you know, where we come from is, let's make a proposal that doesn't annoy France and Germany too much, because otherwise we know it'll never fly. But from the point of view of Luxembourg, if I were as successful in Austria with establishing a capital market as Luxembourg, I would probably not be too fond of the idea of somebody else coming and telling me how I would have to do things from a country that is not as successful in building this capital market. So why I'm just saying this in a provocative way. Some countries will probably have less of a problem turning the Luxembourg supervisor into the pan-European supervisor instead of, and that touches on what has been mentioned before. I think it was an excellent question. We have some very successful countries, and we don't seem to be benchmarking with them. I mean, why is Luxembourg so successful in the area of investment funds? Why is Ireland so successful? And can we not turn this into the European model? We don't do that. Instead, we discussed on how we can sort of limit the Luxembourg model and turn it more into a French or German model. And ultimately, that will not be successful.
Thank you very much for this, which I fully share, and brings us to Johan perfectly. So one crucial aspect of the roadmap is the right balance between European and national experience. And so top-down versus bottom-up. And Sweden, I mean, Harald didn't mention, but Sweden is also an example of a very successful country, in particular concerning savings accounts and occupational pensions. So how can this model be translated to Europe? Can we really use that to mobilize and scale up, and how would potentially we do that?
Thank you, Lena, and thanks for the praise for the Swedish experiences. I think in this area, we do have some positive experiences that we're very, very happy to share our thoughts on. I will say with the investment savings account, or the ISK as it's known, for me also at a personal level, it's a pleasure. Because 15 years ago, I was also working at the Ministry of Finance, but I was working with tax policy. And I was part of a team, a relatively small team, that was tasked with designing a way for households to access capital markets in a way that would be good for the markets, sort of fundraising capital, but also for these households themselves. So really tailor-made for equities, bonds, and mutual fund holdings. So we were working on this, and I have to say, I think when we were done, we thought it was a pretty good thing, but we did not expect at all the degree of uptake that we saw in Sweden. Now, 13 years after launch, half of the population already has one. The assets are between a quarter and a third of GDP already, and growing. And also this, I certainly did not expect this sort of international interest in ISK. So I think that's drawing on what we were doing back then, really. I will go back in time and just share with you some insights. What were we thinking about when we were designing the ISK? So I think we were trying to be mindful of three challenges for households that are accessing capital markets. And the first is inattentiveness. Households do not pay enough attention to fees, hidden costs. So some of these risk premia, they're getting paid to take risk, but some of that payment, the risk premia, are being extracted by intermediaries. That's the inattentiveness problem. The second problem is inertia. So people put money into a mutual fund. They're not aware that 150 basis points is really a lot of money in fees. Maybe they have another wrapper around that would charge another 50 or 100 basis points. They're losing almost all the excess returns just to the intermediaries, and they would just stay there. So you see a lot of the money just getting stuck in underperforming products. That's the inertia problem. And third, administrative burden. So when you had equities in the I say old system, but these are parallel systems. You don't have to use an ISK. You can still use conventional capital taxation in Sweden. But for equities, it meant that you had to keep track of all the shares that you bought. So maybe you bought a share in Saab in 1988, and then another one in 1995, and a few more in 2001. Maybe it was a company that did a few splits or reverse splits or other things. And you had to keep track of everything that you paid, because when you ultimately sold those shares, you have to figure out what were the capital gains. And maybe now some of you think that this is something that the bank could just solve, and we're also digital now. But you might be doing this through different intermediaries, and to some extent we want that. We want to encourage that kind of competition. So really the paperwork, it ended up being not just a burden, but also a big source of error. So back then at the Ministry of Finance, there was very clear feedback from the tax authorities saying this is one of the areas where we see, not cheating, we see a lot of just errors. Households spend hours struggling, trying to figure out their capital gains, and they would still get it wrong. And that would raise the cost of administrating the system to even higher levels. It takes a lot of the fun out of doing this, and it certainly makes it more expensive. So those were the problems we were trying to address. And the way this is done in the ISK is that it basically, the tax that you pay is not affected by changing the composition of your portfolio. It's just taking the value of assets each quarter, applying a notional return that is basically the risk-free rate plus something. We can talk for hours about what something should be, but it's not zero in Sweden, and of course it shouldn't be zero. So it's some kind of representative portfolio with a bit of stocks, a bit of equities, and then you think about what these premium are in the long run, and maybe a little discount. But the ISK is taxed. I will say that it's not tax-free. It has so there's no issue of capital gains. Nothing happens. You don't have to keep track of anything. And then there's no lock-in. Which makes it also very easy. It means that you can use it for a liquid buffer if you want to. Maybe if you're planning to use your liquid buffer in 3 months' time, the stock market is not for you. But being able to put even relatively modest savings into these markets, but having the option to withdraw them without the penalty if things take a turn for the worse, we thought was also a beneficial feature of the system. And then finally, I would say that there's no restrictions in terms of securities being issued in Sweden or even in the EU. So they have to be listed because you have to be able to assess the market value of the assets in a reasonably objective manner. I think that's really the only restriction. So these were ways to address those challenges, and I think the uptake shows that it has been successful. I think when it was launched in 2012, it was also possible, there was no price regulation. Intermediaries that provide ISKs can charge whatever they want for it. But there was very clear communication from the Minister of Finance at the time, Anders Borg. He said, this is a simple product. It's a tax wrapper. It's not a savings product to be fair. It's a way of taxing savings. It's a matter of record keeping for the tax authority in a sense. This is a very simple product. It's simple for the user. It's also simple for the intermediary. So it's very hard to see, he said, why anyone would charge for this, or if they do, why they would charge a lot of money for it. So there was a very explicit expectation on the intermediaries to provide this at low cost or even free, and that's the way it was then, and that's the way it is today. So it's really, really cheap or often free. The only major change in terms of taxation is the recent introduction also of a tax-free base allowance. So ISKs are taxed. There's no lock-in. They're always taxed in the same manner, but there's a small base allowance. So this is really tailor-made to maybe households that have no experience of being in these markets, that they could feel, okay, even with 10,000 euros, maybe I can try and do this, because actually then it's tax-free, completely tax-free. But once you start building up a bit more capital in there, you get the full tax at the margin, which is still modest, but it's not. It's very far from tax-free in a way. So I think those were some of the things we were trying to address, and I think the uptake shows that it worked relatively well. If I can just add one very brief comment on top of that, it's to mention the funded pensions. I think that's a very good point that Harald made, and I think it's going to. In Sweden, the ISK is big, but occupational pensions, that is the bulk of household exposure in the markets. So you have to engage with employers and trade unions to really have them on board if you want households to get to these markets. Thank you.
This was actually a very simple way in which its national experience could actually be very informative for the others. Arnold, continuing on this issue of national versus European and how to scale up successful national experiences, what is, in your view, the actual level of fragmentation in the financial market, and how would it be possible to reach scale?
Thank you, Elena. Thank you to the organizer for having me today and for giving me the opportunity to share
our views on some of those very important matters. So fragmentation actually has multiple facets, right? If we focus alone on fragmentation of market infrastructure landscape, this is quite striking that we have today hundreds of lit or alternative trading venues and several dozens of CCPs and CSDs with which the market participants can or sometimes must connect. So there is clearly something to be done, something to be progressed, definitely. Now, this is the result of many different developments, be they regulatory driven, business driven, but this also partly reflects the fact that today we still operate with 27 different legal, fiscal, and economic realities. And therefore, this is addressing all this. The structural weaknesses are known, right? We know that, for instance, securities laws, corporate laws, fiscal regime remain national prerogatives. So it's going to take a lot of time to address these structural weaknesses. And therefore, what can we do in the meantime to still, try and unlock the opportunities that exist with retail and institutional investments? So we'd like to share just a few thoughts on these opportunities. The first one is, if you can't really change the plumbing, at least we need to make sure that the pipes and the plumbing, that we eliminate all the bottlenecks, right? That the pipes have the right caliber, that they connect at the right intersection, right? And actually, in today's plumbing, infrastructure plumbing, you'll quickly find out that there are many frictions, many points where the system doesn't operate as efficiently as it could. So I think when we talk about interoperability, which is a key word here, we need rather to talk about maximized interoperability, because today there is too many inefficiencies that remain in the current construction. So that's one dimension on which we can work, even with the fragmented landscape that we have, right? We can make things work better. We can make sure that cash and securities flow seamlessly across the pipe, right? And therefore capital will reach its destination in a more efficient manner. Secondly, I think there are, to the extent we can say so, there are some low-hanging fruits on the regulatory front that could perhaps be addressed. Also, in order to strengthen the attractiveness of Europe on the global stage, because European capital markets can also play a role attracting global issuers, global investors as the kind of investment destination. So a few examples in my securitization, definitely, probably the priority number one. We need to provide banks and insurers the capacity to operate, with more calibrated requirements on the capital side, on the due diligence side, right? So there's definitely something there to be done. We cannot be satisfied with the fact that although we rely a lot on bank lending today, our securitization market is barely 1/10 of what it is in the US, right? So that's definitely an area where we need to focus. But there are other, perhaps smaller steps that can be taken. Market abuse regulation, for instance, deters a lot of global bond issuers to come to European markets. Even European issuers are actually using non-European venues when they come to market because they don't want to be subject to the market abuse regulation that applies uniformly for all types of instruments. Whereas for the bond issuers, for instance, they would expect to see requirements that are more tailored to the nature of the instrument. So there is potentially there small steps we can take that can make European markets more attractive. Prospectus regulation is another area. We need to think about facilitating access for certain type of issuers, for instance, third country sovereigns. Today, they have the option to go to other markets like the UK and list without having a prospectus approved. Now, we need to think whether we cannot, take that step as well. So that's the innovation. Another angle. The DLT pilot regime was a fantastic idea, but the result is that it's barely being used because it came with too many limitations. And so I think there is a call indeed to turn this regime into a more permanent framework, waiving the type of limitation and constraints in order to foster innovation and the digital transition. So those are a few examples of regulatory areas where actions is possible, even in a fragmented landscape that could make a difference. And yes, I think the underlying question is, I think we need to discuss what level of risk we're prepared to accept, right? What is where do we put the cursor here? And then, so the plumbing, the regulation, the third and last domain where I think that there are opportunities is new investment products and new solutions designed really to help capturing and fostering investment from retail and institutional investors, and both for private and public markets. Private markets, we know that if we want to foster more participation from VCs or from institutional investors, we need to give them more exit opportunities, right? More exit opportunities means probably developing a more attractive secondary market framework. Now, today, in the current regulatory construction, you immediately fall under the MiFID, the MAR, the CSDR requirements, which are not tailored for these type of assets. So we need to give some more thoughts about creating a specific regime for those type of assets. A little bit like what the UK is considering at the moment with the intermittent trading type of framework. So that's certainly something to consider. On the public side, I mean, of course, we've discussed about the Swedish example, and certainly creating this type of pan-European pension savings mechanism to capture retail savings, and also to contribute to the growth of the second and the third pillar, right? Yes, we need fiscal incentives. We absolutely need simplification from an administration standpoint. The only point there is that I think we need to recognize that we have very different levels of financial literacy across the countries, and some countries will be much more risk adverse than others. So in my view, we should also try and think how in the design of that product we can introduce some dose of de-risking. Because for some citizens, it's not sufficient to say you can get some tax incentive or some administrative simplification. There will be a need to provide some level of protection, similarly to what they get from their on their bank account, right? So I think this is just something food for thought. We need to also integrate that in our approach. But this pan-European product, and I'll close on that. This pan-European product is also very important, very relevant for the potential, construction of a real, true, safe asset at pan-European level. There is a clear opportunity today for Europe and the euro to play a much bigger role. We hear every day calls from global investors about, I want to invest more in Europe. But if we want to attract those big tickets, we need a deep market, a liquid market. We need a reference asset that can provide a real alternative to what the US treasuries are today in the market. We have that potential. I mean, the first steps were taken with the next-gen EU bonds. But if you consider next-gen EU bonds, EIB, ESM, EFSF bonds all together, we're above 1 trillion, but it's no comparison to the 30 trillion of the US Treasury market. So we need to move to a different layer. And the advantage of having this type of risk-free, safe asset at pan-European level means that this is a direct avenue for this pension and saving instrument to invest. And this is a call for much higher institutional investment flows into Europe. So definitely that would be one we would certainly support.
Thank you very much. Our to-do list, in particular for Harald, that keeps increasing as you keep speaking. But Karel, and then I have to really ask you, please, to be a little bit more disciplined with time, despite how important this what you're saying is. So, Karel, two important concepts in the overall SIU are those related to competitiveness and competition. On the one hand, Europe has to become more competitive, but at the same time, perhaps there is the need to maintain a certain level of competition also within Europe among member states. So how do you see this potential trade-off? There is a trade-off, or the two can go together.
Competition and competitiveness. Yeah, first of all, thank you to Pierre and Rolf for organizing this. Fantastic that you do this. Also fantastic that you have this in Luxembourg, because we have to debate a lot in Brussels. And of course, we have a lot of debates these days about competition and competitiveness. And certainly, I mean, what has happened last year with these reports which have been published have created, I think, in Brussels a new wind to look at what's going on in our markets and to look at these debates about competitiveness. But I would warn that, let's say, overall, I mean, first of all, if I see it in the Commission's program, competitiveness, compass, and so on, I think it should be better defined. It should be clearer what it is about. Let's say, because also, for example, recently the IMF criticized this is much more about productivity that we speak about than about competitiveness. So we have to be clear, what is competitiveness? Secondly, if I look at what's going on in the member states as a result of these reports which have come out at European level, I think, yeah, we live in two worlds. Sorry to say, I'm surrounded by two representatives from member states, authorities. But if I see what's going on in Germany and Italy and France and Spain, and in the context of competitiveness, we all know we need to become, as a financial sector, more competitive as a global level. We need to be strong competing with others at the global level. But we see that member states still try to prevent, I mean, kind of creating European global players. We see the problems in Germany. It took so long already for the ECB to take a position on the UniCredit Commerzbank possible takeover. And still until today, we have heard that the new Merz government has pronounced itself against. We know, Elena, in your country, what's going on, let's say, with all these banking troubles. So you wonder about this disconnect. And is there not a possibility for the EU, let's say, which has, by the way, strong competition powers, to intervene? I think that the Commission itself, certainly also on the UniCredit merger, could have said very early on, fantastic, this is in line with the single market. But I see, honestly, a European Commission, which is probably a bit too much refrains too much from kind of pronouncing itself for more competition in a European market. So that's more on the global, on the overall perspective. But then if you look into what is going on with the Savings and Investment Union, with this proposals, I think overall, I would say it's very good, let's say, that I had my doubts, honestly, in the beginning, whether it was good to have a renaming of CMU into SIU. And of course, for us, we all know what it is, but let's say, think about the broader public out there, what they think about this. For them, it's not clear at all. But if I see, certainly at least amongst lawmakers in Brussels, this had brought a new wind. We had, for example, Aurore Luc, let's say, the head of the Eco Committee at CEPS not so long ago. And you feel this, I mean, in the European Parliament, it has brought a new consideration as a follow-up of the report, let's say, to look at more common supervision. So there is a new wind. But again, let's say, then, is it going through to the member states? So that's my other question. Thirdly, let's say, this whole debate about, this long-term saving, I think it's very useful, also from a competition perspective. But there again, if we look at financial integration indicators at European level, at the retail level, we see the data from the ECB, we have the data from ESMA, for example, on the cost of fund products. We see we have no price competition. There is no price competition at European level. So as long as we don't have price competition for financial products at European level, which you should say in a place like Luxembourg as well, we don't have European market. And consumers will be constrained to their national markets and will probably pay, not necessarily in Sweden or in Denmark, in the Nordics, but in many other countries, much higher prices than they could because of a lack of scale and a lack of scope. So if you look at, for example, usage, fantastic. What we have in Luxembourg and in Ireland, but we have 4 times as many funds in Europe than we have in the United States. We know, let's say, what is the consequence of this? Let's say that as a consumer, we pay much more. Again, there are exceptions, like in Sweden, but I think there is a very strong in Sweden and in Denmark, a very strong hands-on attitude of supervisory authorities, much to look at, for example, these matters, much more than in other countries. So there, which points to supervisory convergence, that there should be much more cooperation or much more peer review by supervisory authority to say, look, this one is doing it well, but this one is not doing it well. I know there are cases where ESMA has acted on this, but I think there's much more to be done, which I've mentioned in other panels. So that's about competition at the retail level. I think we desperately need it much more at all levels. And then you wonder what can be done by the EU. One thing which is, or say two further comments, which is discussed now a lot in Brussels, is that I mean, can we consolidate fund markets? Let's say, what can we do to integrate the fund markets? There is this huge consultation ongoing, deadline, by the way, by the end of, or early next week, 97 pages, I think, which is keeping the whole financial sector, certainly those which are dealing with these matters, awake. I mean, asking very detailed questions about trading, post-trading, supervision, and which just make you wonder, where is the Commission going? But there's another noise circulating in Brussels, which is that there is a proposal to withdraw 122 regulated, or say, how do you call it, implementing technical standards and regulatory standards. 122. So which, of course, there are probably something like 500 out there for all financial services regulation. I don't know the number exact, it's only a noise I heard, but 122 is enormous, which makes you wonder what has been going wrong. If you all of a sudden, as a Commission, in the context of a simplification exercise, say there are 122 of these level 2 and level 3 measures, too many. So, have we been regulating as an EU too much, or has this regulatory, whatever, machinery gone too far? And should we go back to the question which I asked yesterday, to the core principles of the single market, which is mutual recognition? And do we need a Commission which is stronger to enforce European law at the center? I mean, this is something which you said in a report which we published last year, with headed by a Danish, the former head of the Danish Supervisory Authority. And if you see, again, in the Nordics, there is a strong attitude of kind of let the single market work, let the markets work, let competition work. And don't overdo this rulemaking, this level 2, level 3, this references in laws already at level 1 to, if something cannot be solved at level 1, to have an implementing laws at level 2 and level 3. We need to have, I think, procedures, which I think also is addressed in this consultation by the Commission, to restrain rulemaking at level 2 and level 3, to go back to simplify rules, but also to make sure that our mutual recognition system, which is the basis of the single market and of competition between the rules, functions.
Thank you, Karel. You actually already sort of anticipated my second question. So given the time and given that I would like to keep 10 minutes for the final conclusion, let me, if you allow me, skip the second question to you, because you already answered on simplification and how to move forward. And let's move more on simplification and effectiveness, regulation and supervision, and level of risk that Europe would like to take ultimately, because it very much boils down to that question. So, Veronique, simplification should not be synonymous of deregulation, and we know it, we hear again and again. But given this, what kind of simplification would be necessary to achieve an effective SIU? And I really ask you to be in 1.5 minutes, 2 maximum, because it's 4 of you in 7 minutes. So 2 sentences. 2.5, not 2.
First, it's like cholesterol, so that doesn't count as one. Like cholesterol, there is good and bad simplification. Complexity is not bad per se. Finance is complex. It's complex like air traffic, like nuclear power. You wouldn't like to simplify nuclear procedures, security procedures. So I think there is a limit to simplification, which is whatever is necessary to properly manage the risk, to have the right risk sensitivity, needs to be preserved. And frankly, from that point of view, maybe there are aspects where we have gone too far, like the leverage ratio, like things like top-down stress tests, like things that are one-size-fits-all, I think are actually misleading simplification, because it may create financial stability risk. Complexity becomes bad when it is not about risk management, when it does not bring value from this point of view, when it evolves into piling up layers and layers of level 1, 2, 3, and guidance and so on, that are actually overlapping or are inconsistent on the same subject across various legislative texts. So, yeah, maybe just as a final point, simplification should reduce costs. At the same time, reducing costs should not be achieved by adding complexity. And this is the case in the retail investment strategy. So I think if we want to achieve the SIU project, we definitely need to remove the text of retail investment strategy and replace it by a simplification, drastic simplification of the customer journey. Because currently it is just impossible to sell an investment product to a client given the accumulation of complexity. Thank you.
Thank you. We already discussed a lot the issue of supervision, but given that we have national experiences, in particular if I look at Joanne very telegraphically, so turning to supervision, in your view as a national authority, how pervasive and how harmonized should supervision be to achieve an effective SIU?
And then I think this is a genuinely complex question, so I will try to give you a short answer, but not a very simple answer.
Yeah, we can put it in the Q&A. So.
Sure. It's striking how different banking supervision is, for example, from capital market supervision. And Ross touched upon some of these issues, the diversity of the actors, the diversity of the market segments that we're talking about, the activities themselves. That poses a challenge. For banking, it's easy to say the size of the balance sheet is a pretty good proxy for externalities between member states. We don't have that in capital markets in the same way. Then we have the diversity of supervisory practices. Clearly, there is scope here for continuing the work on convergence in supervisory practices. That risks creating obstacles to cross-border activity. Finally, we have the diversity in regulation here. Things are moving towards more of a common rulebook. But I think it's important to remember that there are some benefits sometimes also having diversity here. So in Sweden, this is an important point. In Sweden, self-regulation is an important and I would say successful feature of our securities markets. It's relatively strict, but it is self-regulation. Some of it is delegated supervisory tasks, financial disclosures, sustainability disclosures and so on. And some of it is standard setting at the more granular level where the formal regulations are not sufficiently detailed to steer practices. For us, I think it would be extremely important not to lose that scope because we have a very vibrant stock market, and I think that proves the point that this has been successful so far in reconciling the interests of issuers and investors.
Thank you very much. Arno, same question for you. What's your view on the complex question of centralized supervision in 1 minute?
1 minute, okay. Well, efficient and stable capital markets require efficient, effective, coherent supervision, no doubt about that. And maybe because we are based in Luxembourg and that we have this experience with the CSSF, our view is that we should continue building upon the strengths of the national competent authorities, leveraging their expertise, know-how, local anchorage. But also work, having the NCAs and the ESAs working together to reach a more harmonized, a more coordinated implementation of the supervision in practice, right? And to ensure that ultimately we have the same outcome, supervisory outcome. So to an identical situation, you have an identical outcome. I think this is what we need to reach, right? But we firmly believe in the capacity of local ecosystem to thrive and the importance that the national competent authorities have in terms of engagement and it is particularly important when we enter times of stress, where the proximity there will be critical. So definitely on our side, we see this model as being the more adequate, also because of the current construction at European level, where you remain, operating in 27 different type of frameworks.
Thank you very much. Very clear. Harold, given your role in particular as the chair of the FSC, what kind of supervision should we envisage in your view?
I think the Commission is right when they say the important thing is to ensure that there are harmonized rules across the Union. But there are several ways of achieving that the rules are harmonized and coherent. It could be by better cooperation between the NCAs. It could be a centralized supervisor. I think it's important not to get caught up in a smokescreen debate here. My predecessor in the Austrian Ministry of Finance chaired the Vice Persons Group that produced the report many years ago on Capital Markets Union. And in that report, people were also asked, should we have a joint, a common supervisor? And even the market players were divided on that question. So if there are so many different views around the table, maybe it isn't the most important question to address. To harmonize rules, yes, but how to implement them, it's probably, I mean, it also is not connected to the performance of capital market per se, because we have certain types of investments that are booming, like crypto assets, where there is no common supervisor, so obviously there's no link to common supervision. And we have banking union where we have joint supervision, and we still have fragmented markets. So we also shouldn't mix up those two. The supervisor comes in when there are unsustainable developments and there's a lot of exuberance in certain areas. I mean, I'd be happy to see some more exuberance in European capital markets at this point. So maybe that would be the first step to go. And I can say something on the level 2 acts later if you like. I have an answer to that.
Okay, thank you very much. I think we can go to 11:30 because we started late. So let's open now the floor for Q&A. Okay, maybe we start with Pierre, who is in the first row. If we do have, could maybe have 2 microphones, but but okay. So maybe we can. But because we can become more efficient in collecting
I completely agree with you, Elena. You did a very good job with such a difficult topic and with so many facets. I would like to build on what Harald said at the end, elaborate on it, and maybe others can comment on what he said. When you are so much stuck in a problem, which is the one of how to do the supervision, and you say, well, let's work on the idea of harmonization. Isn't that a sign that you need to slightly change the perspective? Because you called it a smoke screen, and I think this is a good description of what it is. I mean, the views that have been expressed in the panel clearly show that you can look at this from different angles. And I also think that Verena showed a lot of flexibility in the way she sees that. And it reminds me about the EMU and the common currency debate 30 years ago, where our German friends kept on saying we can only do a common currency if we have common macroeconomic policies. And then politically, there was a convergence, the Berlin Wall fell down, and then we started the Stability and Growth Pact, and finally we had a common currency, and we did not have common macroeconomic policies. So we are now in a situation geopolitically that's of a different nature, but pushing us to move ahead fast. And I think we need to find a new way to approach the whole thing. We have harmonization as a general feature that the EU is based upon on the one hand, and we have certain goals we want to achieve. How can we do that without having in the middle of that always a debate, how is it about central supervision? We will have some part of central supervision, we have already a part of it, and we will have certainly more in certain areas because it makes sense. But let's not start the discussion from that end because it blocks everyone. So that's how I feel about it. I've been feeling about it for a long time. I think Harald has expressed it very well. Maybe others in the panel would like to say something about that.
Okay, let me collect, or any of you want to give maybe, I don't want to take my UniCredit hat and I'm chairing, I'm not the speaker here, But I think it would be useful to actually start from the banking side and understand a bit how it has worked and how, going back to competition, and who blocks what or who tries to foster what. And if we want the same output, we want to achieve the same output, but is that better to achieve, or is it easier to achieve the same output to the same issue by keeping the fragmentation of supervision or by having a centralized one? I think maybe, while I agree with you, we shouldn't be stuck with the concept of central versus local. Maybe we could think of what has been working in the banking sector. What is it that is not working? Who blocks what in the banking? Because you are right, it's still a fragmented market, but there is a reason why it's a fragmented market. And so centralized supervision can certainly not be enough. It's not sufficient to foster integration. But maybe it's a little help at least, rather than not. I already occupy too much space in answering.
If I may just add one point, I cannot agree more with what you said. The other example is the euro system. Because the euro system works in a different way. There are still national central banks implementing monetary policy with one voice and sometimes different discussions. But I think this is an interesting model as well. Obviously, totally different subject, but that could be inspiring as well. Totally different from the SSM.
John, you want to say something?
In Sweden, we share much of this perspective, but perhaps also a way of saying it is put the most effort on the thing that had the most impact. For us, it was the ISK and the pensions. That's really the game changer. It builds up the capital in the economy that creates the ecosystem that you need to have vibrant capital markets. But I think something has happened during these years that does make it more relevant today to have this discussion, but maybe at a very granular level, which I think Irina Ross was also opening up for, talking about specific areas and so on. And that is just a consolidation when you look at the owners, especially in the infrastructure space. To take Sweden, the CSD, it's Euroclear. The CEO of Euroclear Sweden is also the CEO of Euroclear Finland. The IT infrastructure, which needs to be supervised, is not all in Finland. Let me just say that. So really, it becomes a question: who should be supervising this? I think that is complex, and we should be aware of that because it's moving increasingly in that direction, at least in some segments of this market.
So hands up. So please.
Former Luxembourg finance minister, and indeed anyone on the panel, Harold mentioned the need for practical steps. Encouraging private pension investment programs is obviously politically tricky in several member states. However, even here in Luxembourg, and I'm a prof at the University of Luxembourg, the kinds of incentives that exist to encourage residents to invest in complementary private pension plans are I would think, pathetic. I have recently set up a complementary pension plan with Lux, one of the main Luxembourg insurers. I can only invest 3,200 euros per year tax-free. I have a very generous public pension scheme already through my work at the university, for which I am very grateful, Mr. Gromenia. So the incentives to save in a complementary pension are already rather limited. So then my question would be, are there good fiscal and other legal reasons why the tax incentive on complementary private pensions could not or should not be increased? The tax deduction is also subject to all kinds of conditions, right? So Luxembourg is one of the few countries in Europe that has the fiscal margin of maneuver to do this sort of thing. So if you want Europeans with lots of savings, keep saying this, right, to invest more, make it a lot more attractive. Right, Luxembourg should be leading the way, and not just Sweden, and following Sweden and Denmark, right? However, it does not. And one final question: pan-European pension schemes, the PEP. This has clearly been a massive failure. Only Slovakia, I believe, has taken it up. So I do wonder if there is much point flogging this particular dead horse. There does not seem to be, there seems to be a degree of delusion in Brussels, especially in the Commission, about the PEP. So can you help me overcome my doubts?
Let's also collect Christy, and then.
I have a question on the same topic, but from a different angle. Harold, I'd like to thank you for making your committee's report public, because I think it was really useful. But also the framing on these issues was done in a way that it felt like it almost gave member states an excuse to say that they don't like these European initiatives. Because as I read it, it bundled the tax break, the product, the account, all these things all at once. And it said, should we have this one-stop shop product, as with the PEP, which tries to have the tax break, the product, the account, the portability, the whole bit. my question to the panel is, can't the EU do more by unbundling and addressing each of these separately? Because Sweden, for example, as you were saying, you got rid of your tax break on complementary pensions because they're so financially productive. You don't have to give somebody a tax break to do it. People just want one of these things. And certainly in Belgium, the idea that you need an enormous tax break or no one wants any of these limited and maybe inefficient, expensive products that are offered, that's not a good model forward. We need to unbundle these things so that people can find something, I would think, that works with their individual system without just saying nobody will invest unless the government subsidizes it, because that's the opposite of markets. You're supposed to make money. So I'd love your thoughts on that and how we can convince people on this.
Okay, I'm afraid that we need to go to the coffee break, and Nicoletta is making signs. So why don't we go? Who want to say something? Maybe Harald, for sure, we have to have him speak. So why don't we start with you?
Okay, well, I start with the PEP because probably the answer here is short. I cannot I cannot remove your doubts. I mean, it's obvious the PEP has been an abysmal failure. I mean, it's there, so probably you can still look into it and maybe try to improve it. But in the council, at least, the majority opinion is probably pointless. And it's not because the idea of a pan-European pension product is bad, but everybody is quite aware that the seed of death in the PEP was the tax question, and we're not going to resolve that anytime soon. On the tax incentive, I mean, there's also something in the FSC report on that. I found that very interesting because we asked our own tax people whether tax breaks for investment in equity in particular, whether they're effective in fostering investments in equity. And I think the majority view was, we don't really know, but probably not, which is also a surprising answer. And it was similar for pension provision. People were saying, okay, this helps in the uptake, but by how much? And whether it's the right kind of investment with the right kind of incentive, we have no clue. So anyone can say anything on that. I mean, if I stand by what I said before. If you have the feeling that the first pillar will not be there for you, you will invest in the second pillar. And it's not a matter of tax breaks. It's just a matter of necessity. And if you have a strong pillar providing for you, even with the tax breaks, you might think, well, do I really need this?
Let's finish with Carol that spoke less before.
Oh, I just have an idea. Since we're at the ESM and the ESM has plenty of capacity to borrow in the markets, the reason why we don't have tax breaks in many countries is simply that the fiscal capacity to do it, like in Sweden, which has a very low debt to GDP, many countries cannot do it. Why shouldn't ESM have a plan to say, look, countries give tax breaks, we will lend you money to do it. And you can do it at a very advantageous rate. And in the meantime, we solve the problem.
Maybe that's for another time.
Okay, let's discuss it in the coffee break. Thank you very much to all of you.
No.
Grazie. Rose, you think you have to sit here? If you want, you can. Thank you. So you can go for content if you want.
Kindly take a seat, please.
Okay, for God's sake, whatever you do, don't agree with me. Otherwise, it's going to be boring.
The codes are changing, and I think increasingly you don't need to. So I've decided.
In US, nobody takes it.
Good morning, everyone, again.
Depends where.
In a few minutes, I will have to say good afternoon, but we still have one panel before the lunch break. And now I will have the double role of moderating and keeping the time. So please help me to get to the lunch break in time. We are now starting session 5 on the benefits of capital market integration for society, growth, and competitiveness in the European Union. The panel gathers a distinguished group of academics, policymakers, and economists, and each profile reflects a distinctive perspective about the future of the European financial system. So I'm truly honored to have this opportunity to moderate the discussion. And I will start by briefly introducing our speaker. To my right, Rolf Strauch, Chief Economist and Management Board Member at the European Stability Mechanism and European Stability Facility, Financial Stability Facility, which he joined in 2010. He represents the ESM in several international and European fora and is a member in advisory committees of academic institutions, including the EUI. Since February 2025, is co-leading the CPR Research Policy Network on European Economic Policy. Next to Rolf is Mahmoud Pradhan, Head of Global Macroeconomics for Amundi Investment Institute, which he joined in 2023. In his role, Mahmoud oversees macro research and strategy and is a member of Amundi Global Investment Committee. Prior to that, Mahmoud was Deputy Director of the European Department at the IMF, where he led the IMF work on the euro area and financial sector issues for many years. Sitting next is Nicolas Veron, co-founder of Bruegel in Brussels and senior fellow of both Bruegel and Peterson Institute for International Economics in Washington, D.C. His research focuses on cross-border finance, banking union, supervisory integration, and capital market supervision. Next is Laura Bottazzi, full professor of economics at University of Bologna and faculty member of Bocconi University. She holds a PhD from the MIT, and her research spans financial literacy, venture capital, technological innovation, and the economic geography of Europe. And finally, joining us is Andrea Beltramello, who has been the head of the Capital Markets Union unit in the Directorate General for Financial Stability, Financial Service, and Capital Market Union, DG FISMA. And prior to that, he headed the Resolution and Deposit Insurance unit within the same directorate, DG FISMA. So thank you all for being here. And let us delve quickly into the subject of today's discussion. So in the previous session, we have talked about hurdles, enablers, and key issues related to the implementation of the Saving and Investment Union strategy. In this session, we want to explore the Saving and Investment Union agenda, going a bit deeper into what SIU can deliver to EU citizens and businesses, and how the implementation of these policies can help align the supply of capital to Europe's investment needs. In the afternoon, we will have another panel where we will explore the market perspective, so what the private sector is expecting from the SIU. While here, again, we want to focus more on the economic fundamentals of market integration, the benefits and the long-term impact, also in terms of financial stability and economic resilience. So with that, I would like to start with Andrea and ask if you can provide us with an overview of the SIU agenda with this angle, so thinking about how SIU can deliver on the broader objectives of growth, competitiveness, and stability.
Thanks for inviting me to speak in this conference. Actually, I was sitting there earlier and I was looking at the title and I thought, wow, that's really a great title. And I was thinking about when we were brainstorming, how do we call the SIU communication, you know, the subtitle? And I wish we had thought about something like that, because I think it really gives a great picture of what we're trying to achieve with this. It's basically with SIU, we want to revamp our financial system to make it work better for people and businesses. I think somebody said in the previous panel, this is an enabler, and that's very true. This is an enabler for other priorities that we have, big priorities that the Commission has presented, for example, in the competitiveness compass. It is a sector agnostic strategy. It can work for all people, all citizens. It can work for all companies. It's really about, you know, making the financial system, the financial intermediation, be more effective in the way it matches this huge pool of savings that we have with the huge investment needs that we have. I was thinking about, okay, how can I present the strategy in a few minutes? I have my notes, but as usual, I will ignore them because I heard somebody this morning saying, I think it was you, Veronique, saying, it's a bit of a shopping list. Okay, we wanted to have a strategy, a vision, but I take the criticism. It is a bit of a shopping list. There is also the annex with all the action and by when we deliver them. I think this is also important for our constituents to have these shopping lists. At the same time, I think SIU is a big change. It's not just a rebranding. It is trying to speak more to the people, to the companies, those who need the SIU. There is a change in method as well. I think we are stressing much more that this is not something that you can build from Brussels alone. We need things to happen on the ground, and we need member states to take responsibility for contributing to building the SIU in areas where we have limited competence at the EU level, such as taxation, such as pensions, and other areas which we know very well. And there is also a sense of urgency. So that also what makes it different from what we've been doing in the previous years with CMU. So yes, there is the shopping list, but we also say very clearly, we are going to start this year already from the Commission to deliver those packages of reforms that we think are most urgent and most impactful. We have a plan for 5 years, so 22 measures in 5 years is not so much, but already now we are delivering before the end of the year some actions that I will basically categorize in 4 big themes, or 4 big areas, let's say. The first is precisely the people, the citizens. I think it's super important that we focus on retail investors. It's important that we give them a chance to participate in capital markets, and that's first and foremost because it's important to them to build their wealth, to grow their wealth, but also because their savings can give a very important contribution to the investment needs. And of course, here we cannot do it without giving the people the right incentives. It's not about Europeans being more risk adverse than other people. It's not Europeans are inherently more risk averse than Americans or others. It's just they don't have the right incentives to take those risks. And that's why we want to work on issues like financial literacy, on contributing to creating these savings and investment accounts with good experience from some member states. But again, not necessarily something that can be done top-down from Brussels. As Commission, we can accompany, we can promote, we can give best practice, but it's for the member states also to take responsibility on this area. Second, and closely related, pensions. We discussed it a lot already this morning. And here, again, it's a combination of what can be done at EU level. We have rules on occupational pensions. We have the PEP, which some have said it's a failure. Maybe it's worth trying to reform it, maybe not. We think we should give it a chance. But again, what we can do at European level, and we will come forward with a package of proposals to improve the occupational and private pension frameworks. But again, a responsibility of member states to do the reforms that are needed. We are there to help, to accompany, like the tools like auto-enrollment, pension tracking systems, and so on. So we will come forward with this package of pension reforms by the end of the year. The third big area is the role of institutional investors, of course, next to retail investors when it comes to pension funds, insurance companies, and so on. And here also we know that there are some barriers for them to invest in equity in the strategic sectors that we have, but more generally in all companies. Some barriers are also prudential, and we're looking at them, but there are many other barriers, and we're really committed to come forward already this year with a number of measures that can help to remove those barriers. And finally, the other area, and this big questionnaire that is currently ongoing that Karel was referring to, the deadline is on the next Tuesday, and then we will get to work to analyze all the responses, is precisely on market integration and supervision, on removing barriers. This is not about mandating consolidation or anything like that. It's not about an ideological push to have single supervision just because at the Commission we like everything that is at the EU level. It's really how do we remove those barriers that are really ingrained in some national systems so that market-driven consolidation, market-driven integration can happen. So this will be the big other package that we will come forward by the end of this year. So I'll stop here. Thank you.
You mentioned some of the key areas where the Commission wants to act fast in order to have an impact. And here I would like to invite Rolf to share his thoughts about what could be the most important results to achieve, also considering the role of the ESM in safeguarding financial stability in the euro area, and whether you also see pension as one of the key enablers in this picture.
No, thank you very much, Nicoletta. And let me make a broader argument on how I see the relationship between savings and investment union and growth. And put my argument by saying we need a growth dividend to make savings and investment union work. It's not a one-way street. And pick up on what Natasha said yesterday. What is the narrative? And focusing also on the pension area. And what is the environment? In an aging society, if aging has a fiscal cost, it's very clear that forward-looking either the fiscal cost is increasing or what you get out of the system is decreasing. And that's the reality that we are facing, that public pension systems may be unsustainable because they become too costly, or what people get out of it will be less and will not be as it is today and satisfying. That's reality against which we are formulating the Savings and Investment Union project. And it makes it more than a nice to have and an additive, because we need a different way of getting wealth to people, a more efficient way of getting wealth to people in order to them to be affluent and be happy in the future. And there's the point. So we before identified pensions as one of the crucial pillars of the Savings and Investment Union, having a real broad market. What that means building up a second pillar next to what we have. That means somehow we need to make the savings more efficient, or we need to even save more in the first place in order to build up that pillar. And that obviously has macroeconomic consequences, because what you save you don't consume immediately. So that equation can only work if people are willing to engage in that and if we can convert maybe consumption into investment. If people are willing to borrow in the short term because they believe in more growth in the future. And that is, I think, the crucial part where what you said on the one hand, we want to have the savings investment union to have more competitiveness, but at the same time, we need the prospects of more growth in order to incentivize people to engage and not run into a scenario where macroeconomically this doesn't play out and we have a stagflation or stagnation because we need to build up a second pillar. And that, I think, is a crucial insight that we should have this combination of supply on the capital side, being more efficient, converting actually savings into investment, but into productive investment. And at the same time, offering the opportunity for the investors in Europe and not sending the money just elsewhere, in order to have a system that actually macroeconomically does the trick. That, I think, is very crucial, that we need this simultaneity in order for this overall to work and really bring this capital market to the people and the firms and having them profiting for it. And pensions are particularly relevant here also from an investor perspective, and that was alluded to before, because you can have a long-term horizon. That is why you can actually take investment schemes that allow you to do this. You can invest in firms at an early stage, yes, take some risks, but over time this will taper out and over time this may pay off. And that is why it's so important to also bring in this pension pillar in order to get this equation right in the long run. I think that is why I mean, you asked me for priority areas. We have this discussion paper that was presented here. We have identified the different areas where retail investors can come in. It's the incentive schemes that we talked before, the savings schemes. It's the public pensions, and public pensions, I think, is indeed a crucial point here.
Contribution from the discussion paper. We have discussed a lot about how to mobilize retail saving, how to mobilize capital. And you mentioned that in the end, this capital needs to meet demand. And this is a perfect bridge for a question I have for Laura, because you have been working extensively on venture capital, technological innovation. So Laura, is it a demand or a supply issue? Are we sure that by mobilizing capital, we can actually meet the investment demand?
So let me start by saying that it's both. So it's supply and demand. We keep talking about supply in general. So we've been talking about supply until now in general. So I could make a list of all what limits the supply of risk capital in Europe, which is fragmented markets. So institutional investors that are not going to, they have a cap most of the time on the risk, how much risk they can accept in investment. But let me concentrate for a second who these guys are. So these animal VCs are, okay? Because VC is not only money, mainly, but they give advice, they know the sectors, so they understand whether, there is innovation there, so the product, they give advice also certificate, they play also the role of certification vis-a-vis other kind of investors, okay? It's more easier for a firm, we see back to get money also from a bank because it's a sort of quality, certification of quality, etc. But they don't want to stay into, first of all, there are two characteristics, they don't want to stay into the firm, they want to exit, okay, at a certain point. 8 years, 5, 8 years, maximum 10. And the second, of course, stuff, they tend to control, which is a high cost. So now that brings me, okay, mainly to the other issue, which is the moment in which European VC started was a moment in which really had a boom, was a moment in which new markets were created, new stock market were created, where startup could, of course, be listed without having 5 years of positive profits. And that was a way out for the venture capitalists. Then you have a jump in venture capitalists because they need a way out. We don't have big high-tech firms. There is a way out for VCs. It's difficult, of course, after 5 years to do an IPO in general for them. So that's the huge limit. If you ask to them, there are surveys, they tell you having exit opportunity is highly relevant, okay? And I can say, Howard, to tell you which was the quality of the VC at that time, because there were banks entering into the VC market, okay? And they were not affected at all, okay? They're not very good VCs. So it's completely different from instead VC industry, which is in US, that has instead years and years and tens of years of experience. It's completely different, okay? Now they have grown a lot, VC, so in terms of quality, because we have to say also VC are not all equal. And in fact, you see a lot of investment also in the US coming into Europe, but also because they're able to understand who can grow and who cannot grow, okay, whether it's worthwhile or not to invest in the firm. But let me go instead to the second question, so why they are limited, which is also, they tell you that there is not entrepreneurial, in some way, environment. What does it mean, entrepreneurial environment? Okay, there must be a VC. That, if I heard that, I will not speak of him so nicely. So I tell you which is the entrepreneur. So first of all, entrepreneurs tend to invest in less risky projects in general. But if you look, for example, in the bankruptcy law, you understand which is the difference between the bankruptcy law that exists in Europe and the bankruptcy law which exists in the US that foster a lot of entrepreneurship, by the way. So failure is part of the game in US. Failure is a stigma in Europe, and I can tell you how you can test. We have tested, okay, because the first wage of a bankrupt person is lower in Europe, is higher in US, because at least you have tried to do something, you've been innovative, okay, which is completely different. Here is a stigma. In Italy, until 2006, you could even lose the possibility of voting at the parliament if you were a bankrupt person, if you have a failure on it, okay, you failed. And on the other side, you know, the problem is people keep saying we have small firms, startup, that they don't scale up. And my statement is maybe it's optimal. So not all firms have to scale up, only the good quality ones to scale up, okay? So there is not high innovative activity in Europe, okay? So innovation, in reality, look at the patent is 1/3 of the US patent, but not only, who does patent? Most of it is China doing patent in Europe, okay, to sell their stuff in Europe. And in reality, we're talking at a very small industry whose weight on over GDP is 1/3 of the one in US, okay? As 3% of mainly GDP. R&D expenditure is almost half of R&D expenditure in Europe than in US. Those are guys that want to invest in highly technological stuff, and we are not an innovative, continent in general, Europe. So we have to think of supply on one side, but we also have to think about also the demand on the other, the quality in some way of innovation in Europe. And nobody talks about the second issue of demand, which I think.
For a question I have for Nicolas, because here we have a touch upon banks and about the EU-US gap. So what is your view about SIU can deliver on bridging this gap?
Yeah, absolutely. I like the rebranding in general because it gets us closer to, I think, what is the role of the European Commission, and particularly the Commissioner for Financial Services, which is creating a single financial system for Europe. So I take SIU as bringing the different strands back together after the silos that had been created by this